If 2024 was the year to wait and watch, 2025 has been the year to recalibrate for startups. We have with us today Barkha Mathur, who is the Vice President of our NBFC business. So Barkha, my first question to you is, what is a way of avoiding equity dilution too soon? How can founders essentially move around this?
Equity is for value creation, but debt is for scaling. And I think that's one concept which the founders or the early stage companies should definitely keep in mind. What I'd suggest is identify the need, find the visibility, see the cash flows happening, and then figure out whether a particular problem can be sorted out by going out and getting debt, or do you really want to dilute that long-term value which you can channelize at a later stage. Okay, you can probably get a structure like a receivable financing, can get a supply chain financing, can start getting a discounting done for one of your vendors. There are ways out there, okay? But what's the perception is the companies generally think that the initial commitment from lenders at a very early stage is difficult to find, and that's exactly when they go out and seek institutional investors. Okay, now as the startup space is maturing, there are a lot of NBFCs like us who are ready to take a call on you basis how the financial health of your company looks like.
So equity is for value creation and debt is for growth. Lovely takeaway there. We've seen a lot of founder first sort of strategies coming around. What do you feel is a founder first capital strategy that one should follow?
How I look at a founder first strategy, it comprises of three things. First is to have a control on the business that you have, to identify the opportunity at the right time and with the right set of return. So when you talk about founder first strategy, I feel that it should be a mixture or a blended capital stack. They should look for alternatives. They should know what kind of strategy is required at that very point of time. If it's a value creation strategy, look out for investors. You can predict what kind of opportunity is going to come up. When you are solely focused on growing your company as a brand, that's where I think you should figure out that this is the time when I need to find the right set of investors. That's where I should think about bringing in equity. Okay. So when you talk about founder first strategy, it has to be an amalgamation of both equity and debt, provided you know exactly what your vision is, where you are taking your company to, where you are heading to, and what kind of costs that you're comfortable at. That's where you'll probably divert and find the right set of debt lenders. And also what kind of institutional investor is going to bring what kind of value. Say if it's about getting into a D2C kind of an expansion mode, you need to find that kind of an investor. If you're getting into a B2B kind of an expansion mode, you need to find out investors whose focus has been that, whose portfolio has been that. So yeah, you should have right alternatives and it has to be a blended capital mix.
Absolutely. So Barkha, I believe blended capital mix is really the way to go in 2025. What a question that we get very frequently from startups that work with us is that we're just 1 or 2 years into the system. Is it the right time for us to take credit, to take debt? Will there be large interest payments that we'll have to bear? So what would be your thought process around this?
See, I do get that question very often. I do meet people who are fairly new in the ecosystem and are looking out for various kinds of financing solutions. My asks with them is very simple. Is your vision aligned? Do you see regular cash flows coming in? Are you making enough monthly revenues? Are you scaling enough? Is your plan aligned? If all those questions have a relevant answer, you have the visibility of a cash flow for at least upcoming 6 to 12 months. I think it's a fair ask to go out and seek debt. You might not see a larger quantum coming in, but you'll definitely see people coming in with a smaller check size also. So yeah, get the three things aligned and you're good to go in the market and get yourself financing.
Great, lovely. So For startups which are 1 or 2 years into the system, as Barkha mentioned, that's still an option for them. The numbers, the strategy, etc. needs to be in place, and that's definitely a good option that they can go after. The other side of the coin is the question we receive that we are, say, 12 to 18 months away from an IPO and we're going to go public. How do we kind of align our debt strategy during a period of this sort?
Okay, so at a pre-IPO stage, your investors, your cap table is very sacred. That's one time when the companies are extremely cautious about every next step that they are going to take. We've been fortunate to be associated with many such companies and have seen them coming up into this stage and reaching out to us at a pre-IPO time. I feel your debt can be if positioned correctly, can be part of your pitch, right? So that's not a time when we've seen a lot of people going out and seeking institutional investors. They want to stay guarded, they want to stay in the space that they know with the people that they trust, but yet continue growing, right? So at that point of time, I think the solution or the ask that your business is looking for is the right debt, right quantum, right set of the financiers who understands that at what time you need what kind of quantum, at what time you need what kind of structure, working capital, revenue based, could be like a typical discounting kind of a facility. So yeah, I feel that that's one stage wherein as an NBFC, we've seen a lot of traction coming in. We see people reaching out even more. So that's where I feel we are positioned and we can come into picture.
Okay, lovely, very interesting. So NBFCs like CredAble, we kind of cover everything when it comes to startup financing, from new age startups, tech startups, to startups that are now becoming large listed companies. So CredAble has seen a lot of action in this space in startup financing lately. What is that one tip that you would want to give to a startup founder looking at debt financing?
One thing that I definitely tell the startups that I meet is that do have a visibility of your cash flows. Don't seek debt when you need it the desperate. Start preparing for it. Keep a check on your finances. Financial hygiene is very, very important. Also treat your debt or financiers or NBFC partners as your strategic ally and not just somebody who's lending you money, because you don't know at what time and with what kind of structure they can really help out the business.
Yeah, so Barkha, as you mentioned, and I believe that's really true, that startups need to think of debt from the get-go. It needs to be part of their capital strategy to begin with, not a last resort or something, a parachute that they look at, to save them from a situation. CredAble has been doing incredible work in startup financing, working with some of the biggest brands out there. And I think this market in itself is growing. Startups are booming across India and across the world. And this is a space which is going to be very exciting. Debt as an instrument of financing is going to blow up now. And more startups are kind of coming into this space. So this is going to be an exciting space. We'll keep chatting with you. We'll keep bringing you on. Thank you so much for your time.
Thank you.